Morning, everyone. Sorry for the slight delay in starting today's meeting. We had a slight technical glitch with the stream. Good morning. Welcome to today's meeting of the Local Action Committee. As I mentioned, this meeting is being broadcast live, and for those not able to watch live, the cast is being recorded in the site after YouTube account. Before we can begin, just remind everyone to turn on your microphone, wish to or speak. Received apologies from Mr. Henry, Clive Pitt, Councillor Cartwright, Mr. Pipe, and it is possible that Councillor Cartwright is online. So I'd like to ask Joshua from Central, who are going to mention agenda later. So move on to the meeting held 26th of September 2020. I'm taken as read, confirmed, signed. Is that? That's fine. Seconds. Agenda item 2, question time. We've received 8 questions from different members. Questions and responses have been circulated to members of the committee at the start of the meeting, and will be taken as read. These have also been now published on the council's website for publication. And I'd like to remind members that there's no discussion on these questions. None of the questioners are present. Questioners are on. So whilst a supplementary question has been submitted, it's not eligible, and they're not fine time for the agenda, so that's struck. I think that's it. I don't know what's to be said on. So okay, so thank you. And so we're now going to move to item 3, which is questions asked by members under Standing Order 7.3 and 7.5. Questions. Agenda item 4 items. Agenda item 5, declarations of interest. Do you have any interest that you wish to declare? So there are. So if you do later on that you do need to declare one, by all means, don't be shy in saying that. So we're going to move swiftly on then to agenda item 6, which is the LGPS Central Report and Presentation, which is pages 21 to 50, the agenda pack, and Bush is going to hand the report, and then to have Louis from LGPS Central, who hopefully it's too long presentation, and a long one last meeting. It's 30 slides, so that was a long one. It's not going to be as long as that. And then once that's all, we obviously we can comments or questions. Okay, and the recommendation is to note the report presentation later. Okay, so over to you,
Chair. Morning, committee. So the purpose of this is to provide the committee with an update on public market investments that the fund holds with LGPS Central. You'll start to become familiar with this process. We're moving between Public Markets 1 meeting and private next. So this is like this kind of style of presentation we normally have first on. For our newer members, the fund is an equal owner of Central, alongside Cheshire, Derbyshire, Nottinghamshire, Shropshire, Staffordshire, West Midlands and Worcestershire. Central has been in operation since April 2018, and as at the 30th of September 2025, the fund has about 4 billion in funds invested with Central. That's around 62% of the fund's total assets. In addition, we have around 900 million in pooled commitments to private market investments with Central also. Before I hand over to Louis, there's some fit for the future developments that are noted on the paper at point 11. Since the last update in September 2025, officers, Central and the other partner funds have been closely to progress the outcomes of the Fit for the Future consultation. Points A to D, which I won't read out, page 23 and 24, those points. Louis from Central is here to deliver a presentation. This quarter, the highlight will be on public markets, as mentioned earlier. It will also cover a general markets update and the 4 public market investments the fund holds with Central. So these are the Global Active Equity Fund, Global Climate Multi-Factor Fund, Global Investment Grade Bond Fund, and the Global Multi-Asset Credit Fund. I've got nothing else before we hand over to Louis.
Thank you. Over to you, Louis.
I'll quickly introduce myself first. My name is Louis Hill. I have 25 years of experience working with LGPS investments. I recently started in January. I started at Central working as their investment oversight manager. So that role was an internal kind of monitoring of LGPS Central funds, some of which you invest in, we'll talk about today. Given I started in January, for future consultation came out time. I've spent a lot of time, instead of doing, as well as doing the oversight, setting up the advisory function, which we need as part of that. And recently I've actually moved into that new team, setting up that new advisory team as a client director. So what a client director's role is to actually act as a representative to LGPS Central to you, but also act as your representative to LGPS Central. Alongside that, I'll be moving to advising on investment strategy. So the plan today, as said, is to cover public markets. I'll start by giving a market update, go through the performance of the funds at LGPS Central that you invest in. I'll give an update on some changes to those funds, so I'll plan. Don't know what you'd like to. I'm very happy to take questions as we go rather than wait.
That's fine. Members will, if you've got any questions, just indicate and we'll take them.
Thanks. Start on the So what I wanted, in terms of the market update, what I wanted to start with is some kind of major trends last year, 3 years, 5 years. Big trends, I'm not going to talk exactly to what's on the slide. Big 3 trends I want to talk about. AI, that new technology and its impact on equity markets. Inflation, impact on bond markets. And then what I would call a benign economic background and the credit market. Those are the 3 things that I think have been markets over the last 5 years or so. So starting with AI is probably the one is very familiar with. It's been a key driver of equity performance over the last year, last quarter, over the last 5 years. So it's a bit of background. Equity markets in the last year delivered a return of 17%, global equity markets 17%. Over the last 5 years, they've delivered a return of 13% per annum. Those are very strong returns, above what you would expect from an actuary or investment consultant. As a comparison, Magnificent 7 stocks, which you've probably all heard of, so Apple, Microsoft, Tesla, Alphabet, Meta, I'm sure if I've got those big American tech stocks. If you just the returns of that group of 7 stocks in the last year returned 37%. 5 years, 30% per annum. So huge returns just from those technology stocks. Going forward, the question is that those stocks are now very expensive. And so the question for investors is, will future earnings keep pace with that valuation? Maybe they will, but there are some risks which I wanted to touch on, the signs. So one of the warning signs is that these companies are now, they're spending on CapEx, they're spending, buying chips and so on, is previously was coming from their earnings, but are having to borrow to fund that spending. That's one risk. Second risk, which you're about, is the circular funding that's going on. So NVIDIA investing with OpenAI, so OpenAI buys chips off NVIDIA. Risks being built into the system there. Third risk is the speculation we're seeing in the market. So that's something called margin debt. It's what investors are borrowing to invest in stocks is at all-time highs over the last 30 years. There's a lot of speculation in the market. These companies are very expensive. Maybe it's justified. There's a risk that their future earnings do not justify that. Risk is that they are so huge. Those 7 companies make up 20% total equity market in the benchmark. If they have some issues, that is going to affect across the market and also the wider economy. So equities have had a really, really good run, well above expectation, driven by those tech stocks. There's now some warning signs about. The second theme I wanted to talk about is one that's affected fixed income, is inflation. So you'll know that we've seen inflation increase considerably since COVID, as a result of a lot of fiscal stimulus during COVID and previous to COVID, monetary stimulus. Had inflation at 10% in 22, 7% in 2023, and still this September 4%, so still above target. So what that has caused is a huge shift in yields in the income that investors expect from bonds. So prior to this period, government bonds were yielding less than 1%. Now they're yielding close to 4.5%. That has caused that to get to that level, prices have had to fall and fall. The point is, though, now below 1%, government bonds were not particularly attractive to investors. 0.5%, pretty attractive. Risks remain there because inflation remains high, and also spending, the need to issue debt is as well. Bonds way more attractive a few years ago. The final point about markets, big theme of markets, is that economies of the G7 and particularly the US have been pretty strong or stable to what a lot of commentators were worried. There was a lot of talk about higher interest rates and inflation was going to have a negative impact on spending and result in recessions or very slow growth. That has not happened. Growth has not been great in some countries like the UK, but the US has been pretty strong. A lot of it supported by that AI spending.
If I may, Roy, tariffs, you haven't mentioned tariffs and that imbalance. Yes. Can you throw that into the mix?
Yeah, absolutely. So that's one of the things that is coming onto the you would have expected things like tariffs this year, and there were other events a couple of years ago when some regional banks, Silicon Valley Bank and that, loaded those events. People would think that could cause wider contagion, risk a recession. What's happened is that the markets have looked through. Actually, we can cope with this. There is still high demand for bond-like assets because of those higher yields we talked about, and that has pushed everything down. So yes, you're right. That a lot of people were expecting that could have repercussions for the economy and therefore credit markets, other markets. That has not come through. There's been blips. Silicon Valley Bank, and when those tariffs came out, markets very quickly recovered. So the point being that benign environment, even when there has been those shocks, means credit spreads, so the extra return you get for lending to companies rather than governments, have narrowed, and now you're not getting much extra reward. So there is risk there, but there's another event and markets do not recover as quickly.
Anybody else got any points you want to raise? Just one question I've got, Louis. So just listening to what you've said, is that then reflected in the fund then.
Yeah.
Talking about risk, talking about the big seven, or whatever they're called in the investment industry. But I know there's a kind of jargon for them. But I mean, obviously, you know, if you're getting 30% return a year, I mean, that's just not sustainable. In that, I suppose that's the concern: is when does that run out of steam? And I've read about some of that recently. So I suppose then how's that reflected in performance of the assets under management that basically Central is managing as part of the pool arrangements? Thank you.
Shall we go on to that? So the top 4 lines here are the LGPS Central funds you invest in, and the bottom ones are your legal general passive funds, showing the since you invested, the 5-year, 3-year, and 1-year. So market environment, the first 2 lines and the bottom legal and general numbers are equities. So you can see there the longer term numbers and the short term numbers are double digit high returns from equities. That is driven in a huge part by those AI tech stocks. At the 1-year number, I think this is what we'll spend a little bit of time on, or the top line, LGPS Central Global Equity Active Multi-Manager benchmark, equity benchmark, 17.4%, did 9.8%. So actually a pretty decent return, but a long way behind the benchmark. Probably good idea why that is. It was underweight those tech stocks. So that a little bit. And the other equity fund down, World Equity Climate Multi-Factor Fund, has basically done what it should have done and tracked that benchmark with a small amount of outperformance. The investment grade bond fund, you'll see the 5-year number is basically flat at the benchmark, slightly negative. That's due to that 5 years, including that period where bond yields have increased. Meanwhile, the 3-year number and 1-year number, both for the investment grade and the multi-asset credit, are very strong. That's due to that benign economic environment and credit spreads narrowing. Legal and general funds have broadly tracked in 2%. So we go into more detail into each of those funds. I think probably the one that I'll spend the most amount of time on is this one, because this is where the performance has been disappointing. So this is a global equity fund. So you're getting, you're investing in global equities to give you those returns above the liabilities. It's the key driver of growth for the pension scheme. This fund, it's investing in using active managers to give you outperformance against a benchmark, which you could invest in very cheaply. So the way what Central do, that they have picked 4 managers, Harris, Schroders, Union, and Longview, all active managers that aim to outperform that benchmark over the long term, but outperform in different ways at different times and provide diversification. And actually, until the start of this year, if we was coming to you and looking at the since inception in 5 years, outperformance was outperformance coming through. What has happened is this year, every single one of those managers has underperformed. It is quite an unusual thing. We are aiming to pick managers that outperform at different times and that protect in different ways. So that is an unusual thing. Main reason for that underperformance is that they are underweight tech stocks. They do still hold those stocks. So some of those stocks are actually the biggest holdings in this fund are NVIDIA, Microsoft, and Alphabet. They are below the benchmark weight. Still hold below the benchmark. And actually, until this year, actually the fund was overweight those stocks. What has happened is the managers, you speak to the managers, they are extremely nervous about what I was talking about bubble and the impact if that was to pop. It has not popped. As I say, that Mag 7 was up 37% last year. It was up 20% in the last quarter, and there's some kind of the last quarter Tesla was up 40%. See, there's these huge movements, and the managers are extremely nervous and effectively underweight those stocks. So effectively positioned for that bubble to burst. Now, whether it will or not, we shall see, but they're positioned defensively. The most extreme version of that to touch on is Longview. Their performance over the year is extremely bad. Benchmark, so massive index, up 17%. They are down almost 2%. Very poor performance. They've only recently gone into the fund. They were in by the team back in summer 2024. The reason they were bought in was for these defensive qualities that they have. Fortunately, the timing of that has been bad. The team were not trying to time, and to put a defensive manager in. They were putting it in strategic reasons that they portfolio needed a defensive manager. The timing does look bad in retrospect. They are extremely underweight tech, very defensive companies, such as industrials and health, which have just not performed.
I've got a query here, Louis. So whilst that's, in some senses, it's, you'd think, okay, well, the benchmark, which is the investor benchmark, i.e. how market overall is done, versus how individual market managers that you've hired on our behalf. Actually, that's not what we're looking at, is what our return is, criteria that we set fund to achieve. And that's the bit that's missing from this, because, as far as I can see at the moment, what you're talking about is fund managers versus what the market's done, rather than actually set you to achieve return on the assets you're managing beneficiaries behind. So that's, I'm kind of interested in, rather than, yes, it's useful to understand the market context, but we're not in this for 1 year, 3 months. We're in this for years, a long time, longer than you'll be working for, and longer than I'll be here and everyone around this table will. So we're not just here for, last week's, because as you rightly say, it could suddenly drop. And we saw that with the dot-com boom where, people were worth zillions and then overnight worth. So, that's the nature of it. So in some senses, you're reassuring us that we're not chasing the wave, if I can put it like that, because if we were chasing a wave, very concerned, because the risks are massive. Returns are massive, but the risks to our pensioners, our beneficiaries, would be phenomenal. We need to understand is how are we doing versus the target return. Should maybe be able to answer that. Thank you.
Yeah. So Louis picking on the individual managers, as you rightly point out, and overall the fund return is covered off in the next paper. But just quickly, we're not trying to shoot the lights out here. Our returns are dictated by actuarial valuations every 3 years. Our average base case is about 6%. Our SAA, which is how we've split out the weightings within the individual asset classes, bring us up to about 8% if Hyman's work is accurate over the term. So about 6 is what we need. About 8 is what we're targeting overall through all our investments. That's not just the ones you're looking at here. It's across the credit funds and everything else. Definitely come on to that again.
That's the last one, Jeff.
You mentioned that we're somewhat light in investment in the Magic 7 stocks. Perhaps that reflects the nature of the fund. I just wonder how that compares with this local government sector as a whole, i.e. across the other funds. sorry, the other pools, how we how we are compared with them, or is the whole local government sector light in these investments, or is it just a local? Thank you.
So, sorry, firstly to the chair's point, I'm glad you focus on long-term performance. And as Bhulesh has said, you know, you're targeting around an 8% return from equities. Equities have been more than giving you that return, and now there's built up risk. And to your point, in terms of, I used to work for a company who did the peer group for the LGPS. Sadly, it's not such a thing these days, and it might come back again with what's going on with pooling. If I take you to the table at the bottom, where it's got 3-year, it's got quartile performance versus peers. So this isn't against LGPS peers. This is against effectively all the active managers there, and there's about 1,500 active managers in this in that kind of data set. What it's showing over the 3-year and the 5-year is that they're in the second quartile, so outperforming over 50% of that universe of managers. So longer term in the top half of performance, in the shorter period in the third quartile, so below the median. I've got a bit more detail on that peer group analysis on the next page. One of the things on the table on the right-hand side here, manager relative performance versus all global equity. So one of the things with the grey bar, the green bar for the 1 year is very wide. There's those 1,500 active global equity managers. There's a wide dispersion of returns. You can see the median is the little red bar. That is below 0, the middle line, which is effectively the benchmark. The average active manager through all these periods has underperformed the passive at the market cap benchmark. We kind of know the reason for that. It's because the big chunk of the returns in that market cap are being driven by those large tech stocks. Those large tech stocks make up 20%, at least 20% of that benchmark. And so for an active manager to be overweight, that is to the point, is a very concentrated, very aggressive portfolio in a handful of companies. So most managers have been underperforming in this period.
Yeah, right.
Is this not an argument for more movement into the passive market rather than following the managers? I take comfort for the fact you've got some defensive stocks, because we are looking long term. And all bubbles burst eventually. That's not sort of physics or chemistry. But yeah, there's an argument for putting a lot more in the passive stocks, given the performance of managers.
Yes, I think you couldn't look at that data and think anything but that based on this period. Now you look at other periods, and there are periods where the median is outperforming. But this period, that is certainly something you could take from it. The risk with that is that you would move from this more defensive position that you have now with your active managers, where you're underweight, to being in line with the benchmark, which would be a very large allocation to these tech stocks, which the chair's point could be seen as risky.
Perhaps at that point, Chair, I ought to remind members that I manage funds which a lot of passive stocks were legal in general.
Sorry, you used to, or
I have.
you did? Yeah, okay. You do now, right? Okay, right. So, what I was just going to ask you though, Louis, is given what you've just said, does that mean that Central is looking for these managers to make adjustments to their sort of holdings? Are we saying that's okay, just carry on as you are, or what's the interplay here that's going on? If you're able to allude to that at all, or if it's too sensitive and you're not able to, remembering we're in the public session.
We are a manager of managers, so our role is ensuring that that we believe in the managers' investment process, their philosophy, the team that they have, and the way they manage money. And we retain in those 4 managers. We look at them very frequently, and we retain confidence in them. We're questioning them about their performance, but ultimately it's the manager's decision based on their process and philosophy, what stocks they hold and what positions they take. And so at the moment, that they are taking that underweight tech, and you know that's up to them. But we support it. It fits with their process.
That's great. Thank you.
I've taken the most time on that one because I think that's the one with the biggest kind of underperformance. Hopefully, we'll do the others fairly quickly. So,
It's very helpful, and I think it does explain, and the graphs actually do show very clearly what you're talking about. So thank you for that.
so this next, should we do the climate multi-factor? So this is internally managed by Central, so it's very low cost. It's matching, aiming to match a benchmark with there's a small amount of outperformance coming through. The key here is the benchmark. So this isn't the market cap benchmark. It is this climate multi-factor benchmark. So what that means, the climate element means that it's aiming to have a lower carbon emissions than the market cap benchmark. Interesting point here, as we'll come on to later, we've compared the market cap benchmark at the bottom there. It's got 70% lower carbon emissions, but actual performance is pretty much in line with that market cap benchmark. So you haven't given anything up for that lower carbon emissions. The multi-factor means rather than allocating to companies based on how big they are, it allocates based on some quantifiable analytics to fit with some factors like value, quality, size, volatility. The aim over the long term is to deliver a little bit of outperformance, just a little bit of outperformance versus the FTSE All-World. Hasn't managed to do that, but it's not too far off. The reason it hasn't managed to do that, we can the underweight tech again, but it's only a very small underweight. I move on into the bond funds. So the next one is the global investment grade corporate bond funds. So you invest in investment grade corporate bonds for kind of more secure income, lower risk than equities, lower returns than equities, reliable income source. It's actively managed. So I would always advise against investing in passively managed corporate bonds. Passively managed corporate bonds, that market cap benchmark, you would end up investing in companies with the most amount of debt. Which intuitively doesn't feel right. So you use active managers to invest differently. Investment grade means you're investing in very high quality companies that are unlikely to default. The benchmark here is a 50% sterling and 50% overseas, global with the currency hedged. Come on to a change we're proposing there. We're bringing in a global fund, fully global fund. Got two managers here, Neuberger Berman and Fidelity. Neuberger Berman has the kind of smoother performance profile. It's very diversified. Incremental returns from their credit selection has been successful, albeit not quite at target. Fidelity is a little bit more concentrated, a bit riskier, a bit more of a UK focus. Their long-term performance is not as strong, but their short, medium-term performance has been good, supported by those credit fundamentals that we talked about in terms of nine economy. Peer group on the next page. On the table on the chart on the right, you can see that both managers are fairly close to the median. Then this is what we expect. We're not expecting our managers to take lots of risk and shoot the lights out or risk considerable underperformance. Minor point for those eagle-eyed, the numbers in that table, the performance numbers are not exactly the same as the performance numbers on the previous page, because these are actually global mandates rather than the 50-50 mandate. It's also a far smaller universe of managers compared to these. Keep going. So what I touched on, the fund you're invested in is a 50-50 benchmark, UK global. We are launching a 100% global benchmarked fund. Two reasons for that is partner fund demand. And the second reason is we actually think global is more suitable than 50% in the UK. The global market is considerably bigger than the UK market. The UK market corporate bonds is about £500 million. the global market's 13 trillion. So because of that size, transaction costs are a lot lower. It is easier to get diversification, and we think that there's a wider opportunity set for managers. So we're setting up this global fund. We will keep the 50-50 fund. 3 of the 6 partner funds invested in the 50-50 are remaining in it, and 3 are moving into the global, so that the 50-50 remains viable for now. And we've picked 3 managers already, and the transition will be starting in June. Moving on to multi-asset credit. So this is
Just on that last point then, so quick clarification, are we one of the funds that's moving into that? No, we're not. Shake of the head there.
No, we haven't commissioned any due
Okay,
diligence to
all
move
right.
yet.
Okay, thank you.
So moving on to multi-asset credit. So slightly different to the investment grade credit, this includes what's known as high yield bonds, which are sub-investment grade, so riskier but higher returning than investment grade. So still income driven, lower returns expected than equities, but higher returns than investment grade. Again, using active managers, and the active managers have kind of 2 levers to get returns. One is that they can rotate across different credit asset classes, and the other is the credit selection, like the investment grade managers. In terms of performance, looking at the since inception, the thing that I would highlight here is the benchmark and the target. The benchmark is cash. Cash rates have been going up, and the target is cash plus 4. And it has been very, very hard, now and impossible, for these type of managers to deliver cash plus 4. So the reason being is the bonds that they hold, the yields have risen, the prices have dropped as a result of inflation. So that has meant it's impossible to keep up with cash in that longer term period. The other thing is credit spreads that we talked about have come down, and credit spreads, even the high yield, those higher risk bonds, are now 3 or below. If credit spreads are below 3, it's very, very hard to get cash plus 4. You have to take a lot of risk. So it'll come on later. We're actually proposing changing that benchmark and target. In terms of the 2 managers, that actually performance has been fairly similar over these periods. They are doing different things. CTI, Columbia Threadneedle, tends to be a little lower risk, a bit like Neuberger Berman in investment grade, and Western taking a little bit more risk, but ultimately the outcomes have looked fairly similar because of that environment in bonds and credit. Peer group, both managers fairly close to the median. I would take this peer group with a bit of a pinch of salt. There's only 29 managers in this peer group, so it's a far smaller data set than compared with global equities. Team continues to like CTI and rate them. Western, and I'll come on to that, we are planning to replace soon. To the next page. I explain at the bottom why we're replacing Western. So it was last year we picked up, it's been in the press, that the chief investment officer, a guy called Ken Leach, reported for potential fraud. He had been cherry picking trades to go into a particular portfolio that made his performance look very good, and moving trades that hadn't done so well into another portfolio. So pretty poor practice. He's not directly involved with the fund that we're invested in, but it doesn't look good for the company in terms of governance and investment process. They have been losing assets. We've just made a decision not to exit quickly, and actually performance has been pretty strong, but we are planning to replace them early next year, probably with 2 more managers, which we've completed before. The other big change, the first and second point there, is that we're planning to change the investment objective and the benchmark. So I said it's the benchmark investment objective was cash +4. We don't think that is achievable given the type of bonds that these managers invest in. Therefore, we're changing the benchmark to be a market-based benchmark, like your equity managers, more market-based, and like the investment grade managers, a market-based benchmark +1% per annum outperformance, and we're giving the managers more freedom in order for them to achieve that target. So that's the end of the funds. I can give a quick update on kind of fit for the future and what we're doing going forward, if that's useful.
And let's just check. Has anyone got any queries or further questions on the presentation we've just had? No. So, foolish. No. Yeah. If you just want to carry on, then yeah, that's fine.
Yeah. So just a minute. So, as you know, for Fit for the Future, the greater implementation of investment strategy is going to be delegated to LGPS Central. The committee will remain responsible for setting the strategic allocation, which is the key decision and the key determinant of outcomes. The government has come up with 9 asset classes for you to allocate between equities, credit, government bonds, and private markets. So what we're doing is designing what those solutions will look like for you, what the equity solution look like, what will the credit solution look like. We're doing that by working closely with our partner funds. So we've been working with Bhulesh and the team, making sure we understand your investment beliefs and preferences. We're looking at how partner funds are invested across the board in terms of those 9 asset classes, and then within them. And then we're going to be coming to Bhulesh and the team with some proposals this year before we, ahead of 1st of April, are able to tell you exactly what our house view or model portfolio will be like for each asset class, and how we'll be able to differ in terms of your particular fund preferences away from that house view.
Okay. Has anyone got any questions? Roy?
Yeah, just take it back a bit. You talked about 900 million of uncalled funds. Is that that's a bit high? Can you enlighten us on that, please?
Yeah, it's Councillor Lennon, it's covered on the next paper, but giving you that now, this is to align us back to our strategic asset allocation. So we are underweight certain asset classes, in particular private credit and infrastructure, and a bit in global credit, the MAC fund in particular. So these commitments are standard, but you're right, we're trying to realign, and therefore we're adding more commitments to try and get us back to that. So we're underweight both income block, which we'll come on to, and we're overweight cash as a result at the minute.
Okay, that's good. You happy with that? Yeah. Okay. All right. Has anyone else got any questions, queries? So just want to go back to the report. It's for noting report and presentation. But before we do, just want to remind members about the Fit for the Future changes to the pool going to be happening from the end of March, beginning of April. So we've been to various meetings about this, and there is a lot of work going on behind the scenes, and that the existing pool of 8, so central as it is, we are going to have seven new partners joining us. I think there has been a list that's been circulated previously. Is it out yet? Confirmed of who they're? Are we able to confirm the names yet? We're waiting. All right. Okay. So, I mean, we know who they are, but we're not able to finally confirm them. But when we are, we'll confirm that to members to let you know who the new partners are definitely going to be. It's virtually all but done. It's just waiting on some technicalities. But there is a lot of work going on, which Louis mentioned as well, to get things ready when I kick off. Yeah, it's not long either. So yeah, so there's a lot of work going on. I just wanted to say that. So thanks very much, Louis, for your presentation, and bullish. So is everyone happy to note the report? Yeah, agreed. Thanks very much. So we then go on to item 7, which has been mentioned a couple of times, which is the valuation of pension fund investments, which is page 51 to 74 of the report pack. And Bullish, this is over to you. Thanks very much.
Thank you, Chair. Again, this is our standard paper that we have every quarter. So the purpose is to provide the committee with an update on investment markets. Louis done a great job already, so I'll try and gloss through, just the main points then, not talk too long. How individual asset classes are performing and the fund's total value as at the 30th of September 2025. Included within the report is the scope of the annual review of the fund's strategic asset allocation. So this is our annual review of the strategy. It's included at points 61 and 62, and we'll come on to that towards the end of the paper. The first few points talk to market performance and outlook. Louis picked up a lot of these bits already. So, point 4, generally, global equities had another good year. So we've had a few of these already. The table at point 4 shows the MSCI index in GBP, stripping out any currency effects, obviously. The 3 months to September 2025, returning 9% in GBP terms. So 9% in just one quarter. And the table shows you there, not just the year to date 9 months, but annualized numbers for 3 years, 5 years, and 10 years. So the MSCI World, had we just invested in a passive index, would have got us 14.3% every year for the last 10 years. Points 6 and 7 talk to overall market expensiveness and the fund's diversification. Louis talked earlier about how expensive some of those Magnificent 7 stocks are, and there's a point 6 kind of tells you there that the whole index, if you look at the 1,300 or so stocks which are within the MSCI World Index, they're currently averagely priced at 24 times earnings. So that's historically quite expensive. It's about 50% more expensive than the average of 17 times earnings. Again, noting that these ratios can stay elevated for long periods of time, and they can indeed move higher still. Point 7 notes that the fund is well diversified and is able to weather most downward global market conditions. We wouldn't expect all areas of the fund's investments to be performing well at the same time. It could be inferred, therefore, that, were we in a downturn, then all parts of the portfolio would perform poorly as well. So you should expect to see some parts of the fund performing well at some times and some not. Case in point is that one global active equity product not performing as well as the passive products at this point. Point 8 is the Heijmans Capital Markets autumn report. It's always appended to this report. It talks to a number of points within the global economy. I'm just going to fast forward to points 14 on page 54. Heijmans do a good job each quarter, and they break out equities, government bonds, corporate credit, and UK property. And what we've got here is some bullet points which summarizes what you see within that appendix. Point 15, we've got our usual quarterly table of asset class performance. It's at the top of page 56. The standout classes over the long term still remain listed global equity, US listed equity, private equity, and gold. Gold also has the lowest levels of correlation when measured across a 10-year period. More recently, we've also added the private markets to that table as well. So you can see at the bottom of that table, you've got private equity, private credit, real estate, and infrastructure. And we've got all time frames from 3 months all the way out to 20 years for most asset classes on there. Any questions at this point? Oh, okay, I'll continue. 16 to 18 portfolio changes for the quarter ended 2025. So no changes made to the portfolio other than our normal capital calls for past private market commitments. Cash has had a small decrease, but we're still at 560 odd million. Points 19A to C summarizes the October the 1st investment subcommittee decisions. A number of papers were taken to that report. So this point here summarizes what was approved. So in total, about £320 million worth of more commitments were approved at that meeting. Some of them required additional due diligence, but in the main, we had 120 go to two central private debt sleeves, 90 million to the short-dated investment grade product fund, and 110 million split 65 million and 3 lots of 15 million to Central's private equity funds. Points 20 and 21 on page 57 summarises the strategic asset allocation changes for 2025. This part here is replicated each quarter. We're almost at the end of 2025, so I don't intend to read through those bits, but there is a table coming up which will summarise those bits. Cash holdings, outstanding commitments. I think we've talked about this a number of times. Covered off at points 22 to 28. At the end of September 2025, we've got £561 million of cash, and we've got an additional £59 million to support the currency hedge. Taken together, that's about 8.7% of the fund. It's way higher than we want to be. The target for cash is next to zero. We want it to be fully invested across the asset classes. And to your point, Councillor Denny earlier, that's why the £900 million worth of commitments exist. We do have in total about 1 billion in outstanding commitments. That's the first time we've had so many.
I can just interject
Sure.
there. So talking about this cash holding that we've got, then what's been done then to manage that down then? Because I seem to recall this has been mentioned before at a previous meeting a while ago, and I'm just concerned that it's still there, yeah, which is picking up Roy's point. So I'm just wondering, what are we and our managers doing to, because obviously we can't just send them the money, I suppose. They've got to ask for it, but why aren't they asking for it is the question.
Okay, so multi-part question. So let's look at that question in turn. So we've got underweights in various parts of the markets, brought to committee, investment subcommittee in the main, various proposals. We now have about £1 billion worth of outstanding commitments to managers. If it was all called tomorrow, we would be overweight in those areas. And what I'll do now is I'll move forward to page 59, where we've got a table which demonstrates the underweight areas. So if you look at that table, we've split the portfolio into growth, income and protection. Growth covers the private equity funds, the target return funds and the listed equity funds, and they're pretty much on target. We're about 0.7% ahead of the target. Not a big deal in a £7 billion fund. However, that income group, which covers infrastructure, global private credit, property and multi-asset credit, is underweight, 8.2%. And you can see where that is. The table below that summarized table there shows infrastructure is about 2.3% below its target, which equates to about 160 million. Global private credit, short by about 191 million, and then liquid MAC, which is the multi-asset credit fund, again, similar number. In the column next to that, you can see the commitments that we've approved. So next to the infrastructure underweight of 160 million, we've got 290 million pounds worth of commitments. So my point around, if it was all called tomorrow, we'd have more in infrastructure than we intended. However, we've got money coming back from old investments within infrastructure managers, and we've got this 290 or so million to be called, and that's the kind of delay. We're just waiting for these managers to call the money. We know it will take them a number of years, and that's why we've sized it accordingly. We've got more commitments made to the money that we're underweight by, because we're understanding it'll come back slower. We're hoping it'll go out faster to get us there. We're not in control of when these managers find the opportunities to invest in, unfortunately. It's not like listed markets where you can just invest £100 million into a FTSE 100 fund, for example.
Okay, so there's a kind of infinite timeline in a way. We don't actually know how long it's going to take.
Yes and no. So it's not infinite in a sense. So when we invest with a private manager, it will have an investment period. So, for example, pick an infrastructure fund. They may have 3 years from the final close of that to invest the money we've committed to them. So they still have a time period that they've got to invest it by, but it can be as long as 3, 4, 5 years in many cases.
just sorry, chair's prerogative, but just to finish the kind of try and finish this bit. So at a certain point, given that we've given kind of approval to invest, at a certain point, where does it become a point where we say, hang on, markets have changed, our distribution needs to be different. Actually, we're not, even though we're giving you authority, haven't called it down. Actually, we're not going to give you that anymore. We're actually going to do something else. I mean, is that a scenario that could happen?
Generally speaking, once we've made a commitment, it's a legal arrangement to then hand over that money when they need it. Under certain circumstances, there could be instances within a fund where they may need to close it down, for example. But in reality, once you've made a commitment, it's within their gift to call it.
Sorry, Nick.
Is there any sort of stop date on these legal commitments, or is it infinite? In other words, if they've not called it in after, I don't know, 3 years, 5 years, or whatever, is there?
I think that's the question I'm just asking, but you've put it slightly better than I did.
So I'll answer that accurately now. So you're right. Once they've reached that period, they can't then call any uncalled commitment. So say, for example, a fund has a 3-year call period from the last close, and it goes to year 3.1. They then can't call any uncalled commitments. So you're right. Yeah.
Okay. All right. Just finally, Bruce, the commitments we've made, I'm presuming they're all going to carry over when all of the funds go to being pooled with Central come 1st of April. I'm getting a nod of the head there from Louis. So yeah, okay. Roy?
Yeah, we've got so much uncalled cash. Is there not an argument for putting at least a good part of that into passive funds, which can be accessed quickly if needed, rather than sitting there in cash?
That is something that's considered each year at the annual review. What it would do is it'd give you more market risk, and we've got to a place as a fund where we've allocated 53% to that growth asset class, and that's the level of risk that our investment advisor thinks is appropriate for a fund like ours. So you're right, we could add another 5, 6, 7, 8% to that. We would take more risk, and if there was a drawdown, we'd suffer a bit harder than we would at our current level. So it is something they've considered, and that's part of the last investment subcommittee. We added £90 million to the Aegon short-dated bond product to give us a little bit more than just what cash gives us. So there is a bit of appreciation for what you've just mentioned.
Okay, you're happy with that? Okay, right. So if you want to carry on then. Yeah, thank you.
Thank you. Let's just go back to where we are in terms of cash. So we have invested a fair portion of that cash in fixed deposits, which gives you a slightly higher interest rate than just the money market fund. So about 350 is in fixed deposits, about 4.14% as at the last count. And the fund also holds 136 million across money market funds, which are next day liquidity, which gives you slightly lower returns, ranging between 3.92 and 4.06 at the last count. I'll get past the table that we've looked at, which is at the top of 59, and then go to overall investment performance. Covered off between points 29 and 57. We've got the investment performance, a review of the growth asset class, so that's private equity, targeted return, and all of the listed equity, and a reminder of what the Fulcrum and Ruffer fund does, and those are the 2 targeted return funds the fund holds. At 31, we've got returns for the whole fund versus the benchmark. It's at the top of page 60. We've got the 1 year, the 3 year, and the 5 year. You'll remember from earlier, we said that the time is at the most recent actuarial valuation as at the 31st of March 2025 calculated, and the future investment return of the fund to be around 66.1% in 80% of future simulated outcomes. The table at the top of 60 shows you that the 1 year return for the fund is plus 8.2, the 3 year return is plus 7.6 per annum, and the 5 year is plus 8 per annum. However, you'll note that the comparisons to benchmark over the longer period, so 3 year is still 2.5% below the benchmark, and for the 5 year it's pretty much on benchmark. The annual investment strategy, so this is the paper that we bring, or the presentation we bring to the January committee each year, and takes into account the required rate of return when the fund investment consultant proposes changes to the SAA. The fund does aim to generate a return ahead of that required return, so that's that 6.1% we talked about, and therefore builds in an amount of margin without taking much more undue risk. 38 and 39 talk to the private equity market and the struggles amidst, you know, the increasing interest rates and the fund's long-term view for this asset class. So it's not had a great 3 years as private equity, as interest rates have moved up and the values of those underlying investments been marked down accordingly. The fund does see a long-term future in this asset class, and we maintain currently a 7.5% target weight, and noting the ISC commitments that we made in October to this asset class also.
Nick, you want to come in?
Yeah, very quickly, Bhunesh, the benchmark, clearly it's not achieving the benchmark in recent periods, but is that to do with the fact that the benchmark is set to aggressively, or is it to do with the fact that it's the you know, US 7 tech stocks have done particularly well, and therefore that sort of basically skews the benchmark?
So we've got a combination there, Nick. We've got we reset the benchmarks last year. We've made a lot of our benchmarks harder. We didn't make any of them easier. We added cash plus type benchmarks across the board. So we wanted cash plus a little bit more. So take private equity, for example. That was FTSE All-World previously. So just match what the listed markets do. But we know private equity takes more risk. So we should expect a bit more. So we went listed equity plus another 3%. In many cases, we went cash plus 4 for certain infrastructure funds where there was previously just cash. So we've made them a lot harder. But at the same time, we've also had underperformance. So we've got a bit of both. We've made benchmarks harder, and we've got underperformance, and private equity is a case in point where over the last 3 years, our private equity funds and much of the market has returned zero. Need to carry on?
Yeah, please carry on. Yeah, thanks.
40 and 41 gives you a summary of the growth investments class. So like I said earlier, this is the listed equity, the private equity, and the 2 targeted return funds. You'll note that we're slightly overweight. There's a table at 41 that shows the listed equity, the allocation that we have between those 4 funds and the target weights. We're about 2.8% ahead. That's well within the fund's rebalance range, and we don't need to rebalance. And if we did, we'd only add it to cash in this current state. So there's no requirement at the minute. Private equity is underweight. You can see the 5.4 currently versus the 7.5. Valuations seem to be depressed. We've got a lot of commitments waiting to be called there also. And the 2 targeted return funds, that's the Ruffer Fund and the Fulcrum Fund, both done really well recently, but they're bang on, so we don't need to rebalance those. But those 2 are liquid investments, so we can rebalance those at will if needed. We've got a section between 46 and 57, which is useful to read if you want to understand what those 2 funds try to do. I won't read through any of those points unless there's any particular questions, and I'll move on to pooling progress very quickly. So the government's ambition is to have all our investments pooled by the 31st of March 2026 with your pooling company. That's LGPS Central. We mentioned earlier, we've already got 4.4 billion of that pooled within products with LGPS Central. That's 62% of the fund, plus the other 900 million to come. 61 and 62 go back to the purpose of this report, which was the second part, which was the strategic asset allocation scope. So you've got there at 61 and 62 what we're intending to bring to the January committee, and it's fairly standard in the sense that you get an investment markets review, you get alignment between what our ISS says and what the weights are intending, and if there are any changes between allocations to say private equity and listed equity, rationale is built for that within that January paper. For the first time, we'll have a section on local investing. It's a requirement under the government's Fit for the Future proposals, and so we've asked Hyman's how the fund should approach this, given our current UK exposure already, and Central launching a new product for local investments. I don't have anything else to say unless there are any questions.
Okay, thanks for that, Billish. Roy?
Yeah, I'm just curious whether we've got any targets or much information about geographical spread. I mean, the Pacific Rim is doing well, but Europe's moribund, India's a sleeping giant. Are we looking at the world in that aspect? You say you've got global stocks, which is very mainly American, but there are potentials out there around the world. I just don't know that we ever really get close to those figures.
It's certainly considered at the annual reviews. You're right, we have a very global listed equity allocation, and it'll be skewed towards the US, being circa 60% of all indexes generally. We do have an overweight in the UK also, but to your point around emerging, that's covered within our all-world allocation. So we do have an all-world allocation, but you're right, a lot of that still ends up in the US, gives you relatively smaller allocation to EM. Is there anything you'd want to add there, Louis? I think we hold two funds with yourselves, which the global equity and the climate multi-factor that could possibly help.
A lot of thinking about how we want to design our asset class solutions for partner funds. Our starting place, more often than not, in every asset class, is the global universe. And a big chunk of the global universe at the moment is going to be US based. So that's our starting point. And then it's how do we want to differ from that? Where do we see more value? And is it LGPS Central that's going to make those calls, or are we going to use external managers to make those calls? So we're doing a lot of thinking. Our starting point is global.
Okay, thanks. So has anyone else got any other points or comments they want to make? If not, the report is for noting. Is that agreed? That's agreed. Okay. So we'll move on to, and just to make a note that Mr. Bloxham has left the meeting at 10:30. Okay, so he's not online, and also Mr. Cartwright doesn't look like he's on. He's gone. Yeah. He's gone as well. Okay, so but we're still in public session. So move on then. Thank you very much to item 8, which is the investment advisor objectives. We've probably covered some of this, I suspect, already. But this is pages 75 to 90 of the agenda. And Kat, this is over to you. Thank you.
Thanks, Chair, and morning, members. So this probably won't be a new report for members that have been here a while. Committee receive this annually, and it sets out the proposed investment advisor objectives for Hyman Robertson for 2026, as well as an evaluation against last year's objectives. So we bring this because the fund is subject to regulatory requirements to set and review strategic objectives annually before we enter into a contract or continue to receive services from our investment consultants. So this report confirms that the fund has complied with these obligations, and then subject to committee's approval, we will submit a statement that the fund has complied to the Competitions and Markets Authority. This year's evaluated objectives are appended alongside the updated objectives. They're fairly similar to what we've presented in previous years. There's just added focus on maintaining strong service standards and then supporting the Fit for the Future initiative. And as it's kind of been discussion on before, it's clear with Fit for the Future that there will be impact with how and where we seek advice with the role of Central going forward. So we'll just need to make sure that we're setting clear expectations and address any implications from the ongoing technical consultation on regulations and any further awaited advice and guidance from government. And then we'll, of course, report back to committee as needed. So that's where I'll leave that if there's any questions.
Okay, thanks, everyone. So obviously this is essentially, as I understand, going to cover us up to the end of March. Is that right? Or is this carries on no matter what?
We'll need to see what the implications are of the technical guidance of what is allowed and what is not allowed.
When the government decides to write the regulations.
Yes, but I think to cover that, we definitely need that up to that March.
Okay.
In any case.
Yeah, Nick.
What what would be the role of Hyman's after March relating to us as a council in terms of this committee?
So at the moment, in the draft regulations as they stand, we wouldn't be able to have so Central would be there to provide primary advice, and then in exceptional circumstances, you can seek proper advice from an independent advisor. And I think we need to wait to see what the guidance says about what it means by independent advisor. But it seems like from previous consultations, that would not mean someone that's previously advised the fund. And so, but we need to see what the guidance is because they've not came out with that. But this is one of the roles where committee will appoint an independent advisor to the committee to help assist the committee in that kind of engaging with central type.
Yeah,
role.
so if you're aware, but so basically the government has said that all committees like this, pension administering committees, will have to have an independent advisor to advise them, right? Which is what Kat's just said. But who those independent advisors are, that's not been clearly laid out by the government yet because they're still writing the regulations, or the Treasury is, whoever. But there's obviously been a lot of representations from, the LGPS schemes back to the government to say, how's this going to work, basically? So we're in a position where we don't actually know at the moment what the final guidance is going to be. But initially they were talking about us having to go out and procure a independent advisor who would then turn up at every meeting to advise us, and they would then be essentially saying, not Louis personally, but it might be him who've come along and said, look, this is what we suggest you do. We're going to do this with your money, your investments. And then the independent advisor might say, yeah, that's okay. Or no, they might have said, actually, no, we don't agree. And we think you should do whatever. So then it gets into, well, what happens then? So there's lots of what ifs at the moment. We don't know. So it's kind of, it's kind of best situation that we know at the moment. I think that's fair to say. So it's, sorry, unless Louis, you want to come in, please do.
Just add
Yeah,
to that and
please
maybe
do.
a bit of reassurance, because it does seem that LGPS Central are going to be the principal advisor come 1st of April. We are building an advisory team, spending quite a lot of time. That means hiring investment consultants and support people, procuring risk modelling capabilities, all the things that you would kind of expect from Hyman's. We're trying to build that internally. We acknowledge we may not have that fully up and running in every way come 1st of April, in which case we will call upon investment consultants like Hyman's to support us.
So that process is underway at the moment, but it's the problem is that everyone across the country all the pools are all having to do exactly the same thing at exactly the same time. And it's a finite resource, human resources that are actually available to create these advisory arms, essentially, of our management company. Sorry, Nick.
Yeah, I just think that certain roles, like assisting in terms of strategic asset allocation, that still stays with this committee, would it not?
It does, yeah.
And we would need some sort of support for that.
Well, that's why the government says we have an independent advisor,
Yeah.
in inverted commas. But it's what Kat said.
Yeah.
Is the independent advisor a company or individual who previously advised us able to then take on? Obviously, they'd have to go for a procurement, but are they then able to take on that role, or has it got to be someone who's never ever had any involvement with us before, or for a certain period of time? So therefore, they can come at it afresh and be classed as truly independent. I mean, whatever, it's and unfortunately the timing of all this, you're literally talking 3.5 months, and it's all supposed to be up and running. And as Louis said, it probably won't be exactly perfect when it starts, because there's going to be teething issues, I'm sure, across the whole thing. So we've just got to be mindful of that as well. So we're not entirely sure what it means. I think that's what we're saying at the moment.
Yes,
They-
Chair, there's got to be a limited number of people of the skill base that would be required
Well,
for
that,
this.
this has all been said. This has all been said at other meetings and in other consultation responses that have gone back to government. And we're not going to go into all that now, but that you know, all those views have been represented back to the Treasury, basically, in effect, to say, you know, just the timing of it, the whole timeline is so short and so compressed.
Now, I understand the difficulties that Louis and ones that you're alluding to. The other sort of concern I have, which it may just be perception rather than reality, but if we want to hold, you know, LGPS Central to account effectively within, you know, is this good or is this bad?
Yeah.
To have the advisors, LGPS Central, having their own advisors to advise us on that, is that marking your own homework a bit?
Louis, yeah, please.
So firstly, we will be able to provide you with the advice come 1st of April. And there is very good candidates out there. A lot of the consultancies can see the writing on the wall and are looking to join LGPS Central and the other pools. So I'm confident we will. And if we need extra support to do that, we will get that. In terms of kind of an additional oversight, I think that's that independent person, firstly. I've worked in private sector corporate pension schemes that use a kind of similar fiduciary model, if you like. And what they do is they hire a oversight consultant that will help you look at the pool and performance and provide that kind of third party, help you with that kind of third party expertise. My hope, our hope at Central, is that the 15 partner funds, 8+7, choose the same provider to do that, such that the requests we get for information to provide that oversight come from one provider rather than from multiple. But we expect that you will want that extra oversight in due course.
Yeah, I mean, none of that's been sorted yet. Yeah. Understand the timeline for all of this is the pressure is immense because, as I say, government, you know, even the legislation was still, has it actually been enacted yet?
No, we're currently going through a technical consultation. So
there you go. So the legislation that we're actually working to is still not actually legally on the books. Hasn't actually been given the royal assent yet, but it's expected to. According to the parliamentary timetable. So we're hoping it'll all be signed off. The expectation is it first
ahead of the end of March. So it's a
There
very
you go.
very
so it's one of those. It's one of those conundrums. But why not? Why, you know? But there you go. See, this we're in the hands of the Treasury, basically. Let's hope not. Okay. Right. Are there any other queries or questions on this? I think we've had a good discussion about this. Okay. The recommendation is to approve the Highlands Investment Advisor objectives for 2026 as detailed in the appendix to the report. I'm happy to move the recommendation. Seconder from Mr. Grimley. So is that agreed? That's agreed. Okay, we'll move on then to item 9. Another very exciting issue, local, depending on which side of the fence you're on. Local government reorganisation. And Simone, this one's over to you, pages 91 to 96. Thank you very much.
Yeah. So this report does outline the potential admin implications of the local government reorganisation, as you've mentioned, on the Leicestershire Pension Fund. Obviously, we haven't got a confirmed decision from government yet, so it outlines what the potential implications are under each of the options that we know have now been submitted. So just by way of background, the government invited proposals for local government reorganisation earlier this year, and final submissions were due at the end of November. 3 separate submissions have been made to government. They include the county council submission, which has a preferred option of a single county unitary. So that would be one unitary authority for the whole of Leicestershire and Rutland, and to include current district functions. So rather than having the current two-tier arrangement, would be moving to a one sort of tier unitary authority, and that's the county's preferred option, is to have that single county unitary. The City Council have also submitted a preferred option of still a single county unitary, but with an expanded boundary for the city. So that single county unitary would be a lot smaller than under the county's preferred option. And then the districts and Rutland have been working together and submitted a third option, which is a 3 unitary model, which is basically splitting the current county area into 2, a north and a south, with the city remaining unchanged, but with Rutland coming into that north option. So they're the 3 options that government have now got to consider. They will be consulting on those early in the new year, but we're not expecting a decision from government on their preferred option until we expect it to be around July time. So there's going to be a little bit of a period of unknown over the next 6 months or so. But what I've tried to do in the report is set out what we think the implication would be under each option if it was the preferred option moving forward. So under the single county unitary for Leicestershire and Rutland, that would maintain the current scheme membership as it is now. So all of the current scheme members across the county, Rutland and the districts would still continue to be members of the LGPS in Leicestershire. It's just that their employer would change. So rather than having the districts as separate employers under the fund, it would be the single county unitary under this option. We do think it would require a new administering authority designation. So the county council is currently the AA for the fund, and because under this option the geography is changing slightly to include Rutland, the county wouldn't be a continuing authority. So I don't think we could assume that the county council would continue to be the administering authority. There would need to be, I think it would be most likely, but there would need to be a legislative transfer just to confirm that, because in this option there probably isn't any other sort of real options. This would involve employee contributions, need to be recalculated, lots of valuation work over assets and liabilities, for instance, and quite a lot of admin work for the pensions team in sort of transferring those scheme records. In terms of employees themselves, they would have very little impact because they would remain part of the Leicestershire scheme as they are now. There may be some employers have slightly different discretion. So for instance, some employers might offer additional voluntary contributions and some may not. So there may be some minor impact around some of those discretions that may currently be offered by some of those employers that under LGR wouldn't exist, and it would be the unitary authority. But we think they would be fairly minor. So that's a single county unitary option. Then in terms of the expanded city, there would be similar admin implications in terms of that kind of transferring member records and kind of contribution rates and asset liability revaluations. And we think in this option, again, it would make most sense for the single county unitary to be the administering authority, because that would be, the area that the county council sort of currently controls. So we've got, it would make it simpler from a procurement perspective, from ongoing contract perspective. But you have got the larger city that would be a potential option to be the AA. But again, it would require Secretary of State approval to designate which of the authorities would be the administering authority. But again, all of the issues around membership would be as a single county unitary, and very little impact in terms of the fund itself. The third option, the 3 unitary option, which is a district and Rutland preference, that would obviously split the county area into 2 new unitaries. So rather than having the one single unitary, you'd have 2 with an unchanged city council. So in that scenario, again, we need to think about who would be the administering authority, because you'd have a north and a south unitary. There's a couple of different models that could be considered under this 3 unitary option. So it could be that one of those 2 new unitaries would be the new administering authority, either the north and south, and would host the fund. And that is the most common, and we've seen that in other business cases already. It could be that the strategic authority, which is going to be one of the layers that sort of sit above the unitary, could take on the administering authority. Or the third option could be for a single purpose pension authority, which would again be a standalone authority that would take responsibility for the fund as a whole. Now, I don't think that, well, Surrey, in their most recent business case, have proposed that as their option. So to have this single purpose authority sitting above there, I think they've got a 2 unitary option. What we don't know yet is what government's view on that is, and that would require Secretary of State approval. And we think that would be more complex and certainly would include an extra layer of bureaucracy in that option, because you've got another authority rather than having one of the unitaries taking on that responsibility. But that potentially is another option that may need to be considered. And then just in terms of the admin workload, I've touched on this slightly, but regardless of the option, there will be quite a large increase in workload for the pensions team. In terms of, we think leading up to LGR, there's probably going to be more requests for estimates for employee changes as we move forward to the new authority, possibly changes in admission agreements as well, and obviously all of that transfer of member records. So there will be quite a lot of work leading up to LGR. But in terms of the impact on the overall membership of the fund and things like the cash flow, there won't be any sort of significant detrimental impacts there. Had Rutland decided to be part of the Lincolnshire option, if you remember, the interim plan option for Rutland potentially included them moving over to Lincolnshire, that would have been, I think, more of a concern, because that would have meant transferring membership and assets and liabilities from the Leicestershire Pension Fund potentially into Lincolnshire. The final submission for Rutland doesn't include that as an option now, so that kind of risk and uncertainty is off the table really, and we are now back to just looking at those 3 options that all retain the membership within Leicestershire. So still quite a lot of work, but there isn't that risk around potentially losing some of that membership. But I guess just to finish off, what we don't know yet, obviously, is what the government's preferred option will be, and won't know that for some time. So this is just kind of a run through of what the potential implications are, but we will have to wait until probably the summer before we can be really clear about what it means for the fund.
Okay, thanks for that.
Questions?
Simone, has anyone got any questions? Nick?
I know this committee will not have any impact on which option is chosen by the government within that, but we just want to make an observation really, is that whichever one is chosen, it's imperative to try and minimise the administrative disruption, because that is actually really important to the members of the fund in terms of being able to, get hold of their pension, understand, have queries within that and get it organised. And it's actually pretty good here.
Yeah.
And there are places in London where it's not.
Yeah.
And that makes a huge difference to people. So minimising disruption is key, I think.
So just on that, Nick, what I'd say is just picking up what Simone's just said. So the government timetable is that they're going to go to some form of consultation March, probably, which would then so they'll do, and based on what I've seen already, it'll just be putting the 3 proposals that have been submitted out to a public consultation, the government or any stakeholder, any member of the public to respond to them. Committee could then decide it wants to make a response to that consultation. That'd be entirely down to the committee if we wish to do that as the administrating authority. What can I possibly say? It is at a time of, a lot of other changes we just talked about earlier. Got Fit for the Future going on, which is a lot of work, and we've also now got this LGR uncertainty, which is going on as well, which either way is going to create a lot of work, and also members of the scheme employees who are going to be thinking, well, do I stay with one of the employers who are members of the scheme, or do I go somewhere else, in which case I'm going to want a calculation of my benefits, and also, all the models envisage a number of staff being made redundant at different levels. So there is going to be an increased workload. Exactly how many staff are involved, stick your finger in the air a bit, but there are significant numbers who are expected to, one way or the other, exit the local government sector because of the whatever mergers come about. It's not nothing. So I think that's just what I'd say. But thank you, Simone. I think that's given us an appraisal of the situation. Roy?
Yeah, a couple of observations. I know the city have actually put 2 suggestions forward, either or. So we've got 4 on the table to in effect. We've done away with 1 tier of local government, but we're creating a mayoral is that the word mayor or something to that, a strategic authority above. So there's still just as many layers, but I think that's the natural place to house something like this. If you're splitting everything else up, that strategic authority must be the best place to put this fund.
No, I don't think, no. So the proposal is there be a combined authority, and then there may or may not be an elected mayor. But you know, you've just seen yesterday the government announced a delay of 2 years to the elections for new mayors, which they've already created, which was supposed to be this year. They're now going to take place in 2028. So whatever is said, there's no certainty until the orders are put down in writing by the government in the regulations. So it's incredibly turbulent in terms of local government. So, but I think we're asked to note the report and potential administrative implications of LGR on the Leicestershire Pension Fund. I think we can all agree that. I think what it does suggest is that probably you are going to have to look at the budgeting of the administrating fund to ensure that we've got enough capacity to deal with any unexpected pressures that come about, because that you know, and also, you know, I'm not being flippant about this, but it could just suddenly be announced because the timetable is before recess next in July, and then suddenly be announced, and it could be full steam ahead at a drop of a hat. So, you know, this is the other problem. We don't know, you know, the timeline that we're working to. Simone?
Just to add to that, the timetable is extremely tight. So as you mentioned, we are expecting a decision in the summer. Then the shadow authority on the current timetable would go live the following April 27, and then the vesting day, which is a new authority sort of formally going live, would be April 28. So there would be a huge amount of work to do in about 18 months, including all of that admin work for the pension fund that I've just mentioned. So we may have to review the budget mid-year and bring some updates through.
Yeah,
It would be
no, we
I
understand.
think.
Okay, that's great. Thank you. So is everyone happy to note the report? Okay, thanks very much. What I was going to just suggest is we just have a quick 10-minute break, if that's okay, comfort break, and we'll come back at say just let's say quarter past 11, if that's okay. Everyone happy with that? Yeah. Okay, thank you. Okay, welcome back everyone to the second part of our meeting. We'll just remind everyone we're live and the meeting's recorded and being live streamed, so we're in public session. So moving on to agenda item 10, which is risk management and internal controls. This is pages 97 to 108 of the pack. Bulish here is going to introduce the report. Thanks very much.
Thank you, Chair. So the purpose is to report and inform the committee of any changes to the risk management and internal controls of the fund. Also includes a piece around the oversight of LGPS Central, update on the fund's external audit, and ask for approval to delegate a response to the government's Fit for the Future technical consultation, which was mentioned earlier. Back to the risk register, 19 risks on our register, split into 6 categories. So that's investment liability, employer, governance, operational and regulatory. We meet once a quarter. These are the officers, and we review these risks via impact and likelihood of each. It's a fairly standard methodology. It gives you a current risk score. 1 being the lowest, 5 being the highest. Multiply the two together, impact and likelihood gives you a max of 25. We then look at any actions and additional controls against those risks, and the impacts and likelihoods are then rescored, and we get a new score. And we report once a quarter to the committee. So we've got residual risk score. So this is the after additional controls. Anything over 15 gets you a red. Anything over 8 or equal to 8 and above gets you a medium or amber. And anything under 8 gets you a green or low. Covering off between points 12 and 20 are the revisions this quarter, all of which are words only. We haven't changed any scores. There wasn't any large changes between the 2 updates. I don't intend to read the changes through and move to oversight of LGPS Central. This is via the Joint Committee. The Joint Committee consists of 1 elected member from each of the 8 partner funds. Meets twice a year. Our fund's representative is Mr. King, the chair of our committee. The role of the committee is to provide oversight and delivery of the objectives of the pool, delivery of the client service, and delivery against LGPS Central's business case, and to deal with common investor issues. The last meeting took place on the 17th of October. A number of items were considered. That's at points 23, A, B, and C. If there's any questions, I'm going to move to pension funds external audit. County Council's Corporate Governance Committee met on the 24th of November to consider the external audit and the 24-25 statement of accounts, including the pension fund accounts. It was agreed that the Director of Corporate Resources and Chairman of the Corporate Governance Committee be delegated authority to approve and sign the financial statements and letters of representation. The auditors anticipate issuing an unmodified opinion and note the strong financial sustainability of the fund. That's 140% funding level versus liabilities, and governance arrangements are appropriate and effective performance management is in place. And finally, the last recommendation is that the Fit for the Future technical consultation, which is due to be returned on the first week of January, is delegated to the chair of the pension committee and the director of corporate resources.
Yep, thanks for that, Bulish. Has anyone got any questions or comments at all? I can tell you the joint committee meeting is exciting. But it's very important. So I'm making light of it, but it's been quite an interesting thing so far. A lot of discussions about Fit for the Future, and similar to the ones we had earlier. So essentially, but just across a wider geography, essentially. Okay, with that in mind, we've been asked to note the report and approve the revised pension fund risk register. So I'm happy to move that recommendation. Mr. Grimley, second. Is that agreed? That's agreed. Thanks very much. We're also asked to approve the delegation of any response to government's Fit for the Future technical consultation, Director of Corporate Resources, in consultation with myself, with the chair of the local pension committee. Happy to move the recommendation. Can I have a seconder, Mr. Grimley? Is that agreed? That's agreed. Thanks very much. So move on to item 11, which is the final substantive item, which is the climate related disclosures report 2025 and responsible investment update, which is pages 109 to 172. Kat is introducing the report. And as I mentioned earlier, we've got Joshua Simpson, and we've also now got Edward Baker from LGPS Central for this item, who will also deliver a short presentation. But over to you, Kat. Thank you.
Thanks, Chair. Yes, so this is the quarterly responsible investment update. So we've got progress against the annual responsible investment plan, engagement activities from the last quarter, and then probably the kind of biggest part of this report is the annual update of the fund's climate report and metrics. So Central will be able to give some more context and colour on the report because they produce it on our behalf, but I suppose just to highlight, the report goes into quite a lot of detail about the progress that committee has made since 2019 and we first started kind of disclosing these metrics. The report talks about the activities from the past year, how committee has considered climate risk in its discussions, and kind of talks about how climate risk can be considered in our risk management framework, and kind of has a bit of a deep dive into the fund's climate metrics that we're able to report. So as I've said, this has been developed over quite a number of years, including as a result of committee feedback in focusing on the potential risks and the kind of linked to financial factors in the importance of monitoring these risks and how we can engage with underlying companies. The report shows strong progress, having achieved both interim targets that were set by committee in 2023, as set out in paragraph 15. This is all while the fund continues to grow and perform strongly in investment performance, as set out in paragraph 16. We can also compare against peers, and so when we compare the weighted average carbon intensity metric, we are placed ahead of most LGPS peers, indicating a lower carbon price risk. Part of this engagement and management of climate risks includes our engagement with underlying companies. So within the report on paragraph 33 onwards, there's proposal to add 3 companies to our engagement priority list. These are companies that Central have identified are kind of have a perceived level of climate risk to the fund, which is kind of based on their weight in the portfolio and Central's ability to engage. It's also proposed to remove Taiwan Semiconductor Manufacturing Company as its emissions are now relatively low despite its portfolio weight, and Central have included a kind of public engagement of their activity within the appended reports, and then there's some more information in the exempt part of the paper. And of course, there's the normal engagement updates within the report. The reports will feed into the strategic asset allocation review, and we'll also continue to monitoring these risks to the fund and how Central engages with our top emitters. We'll bring back a new responsible investment plan in January, and then, of course, we have the outcome of the ongoing responsible investment survey, and which will feed into the review of the net zero climate strategy. But if there's any questions on those points, otherwise I'll hand over to Central and their presentation.
So, does he want to ask a question? Oh, right. Okay. Oh, he's got his hand up. So, Councillor Cartwright, did you want to ask a question?
Thank you, Chair. Yeah, I apologise I can't be with you this morning. But Kat, when is the next review for the climate change? That was all. Thank you.
So it's scheduled for 2026. So as you remember, in September, committee agreed that we would go out to engage with scheme members and employers, and that includes on our kind of high level net zero targets and how we manage risk along with other responsible investment issues. So we've got a workshop scheduled before the March committee, and so we'll kind of bring the outcomes and the high level themes and how that can feed into our net zero strategy review, but it will be reviewed over 2026, but we'll have a new version for committee to approve in 2026.
Thank you. Very helpful.
Okay, do you want to move on to the next part? Thank you.
Well, good morning, everybody. Thank you very much for the opportunity to come and speak with you. So myself, Ed Baker, and Josh will be just giving you just an overview on this report. So if you go to the next slide, please. So these are the types of topics we're going to cover. I think, first of all, just an overview, a reminder as to the drivers behind the report and the structure. And then Josh is going to talk through the metrics and how things have changed perhaps over the last 6 years. And then we'll finish up with a review against other targets that you set. Slide, please. So the climate report that we produced for you is based on the Task Force for Climate-Related Disclosures recommendations, and this had 11 recommendations structured around 4 different pillars: governance, strategy, risk management, and metrics. And so the report is structured to cover all 4 sections. I think the value add of this report is you can have a methodical approach to looking at this issue and how it impacts on financial performance. And it's also a useful communication tool for members and other stakeholders. Next slide, please. So the 2 real ways in which this is relevant to financial performance is first through what are called physical risks. So these are the direct impacts of extreme weather events and how these can impact real assets. Now, of course, these types of weather events have always happened. That's not new in itself. What is different is that climate change alters the odds and the severity with which these events happen. You can see some insurance data on the screen here. Again, there are other factors at play, such as the fact that cities have got larger over the time horizon of the last 20 years. Therefore, they're bigger targets, more assets likely to be damaged when extreme weather events occur. But nonetheless, there is an upward trend in the data, and the further back you go, the more apparent this becomes. And so if you are investing in real assets, then it is important to know where the pockets of vulnerabilities are and how your investments are positioned. Otherwise, that could impact the ability of the delinquency rates within the portfolio, and it could also impact your ability to sell the asset at the end of it. Next slide, please. The other factor is what's called a transition risk. So transition risk is this idea that technology and policy changes can change the world underneath your business strategy. So an example of this could be, for example, a mobile phone. About 15 years ago, lots of people carrying around Nokia phones with buttons on them. The company was in a very dominant position, but then there was a technology change and a shift towards iPhones and a touchscreen technology. And as a result, that company, which had a very large position in the market, no longer does now. And you sort of see something similar happening in the energy space at the moment. So energy companies, of course, have been important for pension funds, have been very reliable payers of dividends, and that remains the case. But what is also true is you see much more competition between different sources of energy generation technologies in the world now. Though for the last 5 years or so, across all the major markets which LGPS Central invests in real assets, 90 to 95% of those new energy projects that come on stream have been in clean energy. And the expectation is that this trend will continue. Of course, it's influences by different factors. Different countries perhaps have different policies. Some countries which are net producers in oil and gas have more of a competitive advantage in those technologies, so they may prefer to continue with that. But on a global level, the expectation is that by volume, clean energy will see the fastest growth rates. On the slide here is a report from McKinsey, which outlines different sets of scenarios. But I think the important thing is that response to climate change is driving technology
change, and it's also has an influence at a policy level, which in turn influences key markets such as energy, and this in turn has implications for financial investments. So without further ado, I'm going to hand over to my colleague Josh, who's going to talk through the specifics of how we look at this at Central and the latest stats from our report.
Yeah, thanks, Ed. And I can see the slides have got a mind of their own, so hopefully I'll either keep up with them or the reason why they're flicking, I'm not too sure. But so in line with what Ed mentioned, I'm going to be talking a little bit about the metrics we mentioned throughout the report and why we've selected them, and then we'll go on to talk about performance a little bit, both against benchmark and against targets. So to begin with, it's worth mentioning the reason why we have multiple metrics is because at Central, we don't believe there is a single metric that captures the climate risk adequately. So we look at it in a few different ways. And 3 of the headline metrics that you'll see throughout the report are on the screen at the moment. So we have our financed emissions. This is a standard high-level measure of emissions. So this is quite simply showing the total carbon emissions linked to the fund's investments. This is good for tracking over time. It's also good for understanding potential impacts. But what it's not too good at is comparability. So in order to fill the gaps left by this metric, we use something called normalized finance emissions, and you'll see both of these throughout the report. Normalized financed emissions captures emissions per £1 million invested, and the key use for this metric, is comparability. So this would allow us to compare a fund of £5 million to a fund of £50 million. The final metric on this slide is weighted average carbon intensity, which Kat mentioned earlier. And this captures a slightly different aspect of the risk. This is where we talk about our exposure to carbon intensive companies. And the idea is that through use of multiple metrics, we can adequately capture that risk and therefore price it correctly. Can I have the next slide, please? So one of the downsides to the metrics we've mentioned so far is that they tend to be static or backwards looking. They're useful again for tracking ourselves and keeping ourselves up to targets. But they do have a gap which is forward looking. To fill that gap, Central has developed our net zero alignment methodology, which is made up of the 3 metrics you can see on the screen. The point of these metrics is to give us an idea of what's coming down the line and what to expect. That gives us an opportunity to both mitigate the risk associated with that, but also to capture the opportunities that could be there. The way we do this is through the low carbon transition score. Excuse me. That gives us an idea of the context we are at the moment. The science-based targets and the implied temperature rise give us an idea of what's coming down the line and how well positioned we are to deal with those risks and those effects. Have the next slide, please. One of the other things that we report in the report is about data quality and availability. This is one of the recommendations of the TCFD consultation that we report. The key takeaway from this is that reported data is more accurate than estimated data. And as you can see on the left-hand side in the bottom visual, when it comes to equities, over time, it's a positive trend where we're seeing more reported data and less missing or unavailable data. And that's on the bottom right-hand side, we can see the same visual, but for fixed income. And as we can see, there's a very different trend to that. This is expected, and this is based on live data of the funds. But historically, we've always had less data with fixed income. The largest part of that red section on the bottom right, the missing or unavailable data, is from the MAC fund, and that comes from some asset classes within MAC are traditionally less have less reported data, and therefore that's something that we have to work on over time. But it's something to be aware of when reading through the report. Next slide, please. The final point on metrics that I'll talk about, and I'll open up for any questions after that, is our exposure metrics. So one of the other things we look at is our exposure to fossil fuels, thermal fuel, and clean tech. And the visual you can see across the bottom of the screen there is live data that has come out of the report. So we look at our absolute exposure, And we also look at the exposure apportioned by company revenue. And again, these are two slightly different ways of looking at the same thing in order to give us a better idea of that risk and better price that in. And yeah, we can see across the bottom left the performance against the benchmark. So in each of those bubbles on the left-hand side is Leicestershire pension funds performance, and on the right-hand side of them is the benchmark. So that's an overview of the metrics that are in the report. Just to reiterate, the reason why we use them all is to capture different aspects of the risk and therefore price it in effectively. Is there any questions on that before I move on to performance? Okay. Slide, please. And again. Thank you. So in the performance section, we'll be going over the 3 headline metrics that were mentioned earlier: financed emissions, normalised financed emissions, and WACC, or weighted average carbon intensity. This slide has the first 2 of those. So this is about financed emissions and normalised financed emissions. We can see lots of green arrows, which is a good thing. That means that the management of the risk is going well. So we can see on the visual on the left-hand side, the financed emissions, which is the columns, are going down. So since 2019, there's more than 40% reduction. And against the reference index, there's more than 25% of a reduction. And again, which is about our exposure to the risk compared to benchmark. Asset under management has gone up by more than 30% since 2019, which is generally a driver of increased financed emissions. So that kind of gives us an extra emphasis or an extra value to the reduction of emissions that we see in that first section. And on the flip side of that, the normalised emissions, which doesn't account for the increase in AUM, are down by 60% and 30% against the benchmark, respectively. Next slide, please. And this is the same visual as before, but this is for WACC, or weighted average carbon intensity. And we can see the trends are all going in the right direction. So we're down 55% versus 2019 and just under 40% versus the reference. So performance and management are going well, and the managers on our behalf are doing well in managing this aspect of financial risk. Next slide, please. And this is the final slide of this portion. So to your point earlier, Chair, it's one thing comparing against benchmarks, but what's important is comparing against the internal targets. We set both primary and a number of secondary targets. As Kat mentioned earlier, the primary targets are very much on target, potentially achieved. The first one, a reduction of absolute carbon emissions of the equity portfolio by 40%, is being overachieved. The WACC target is a reduction by 50% by 2030 and is also being overachieved. So assuming no big changes, we're on track to achieve them. There are a number of secondary targets which are noted in the report, but one particular one to highlight during this presentation is about the 90% of assets under management in material sectors to be classified as net zero aligned or aligning. And we can see in the detail in the bottom right hand side that that's steady at the moment rather than increasing. So something to be aware of, and one of the targets that we aren't hitting right now. So that's a quick overview. I realise we're the last portion of the public section, so whistle stop tour, but if there's any questions, please do ask.
Okay, thanks very much for that, Josh. Has anyone got any points they want to make or comments? I mean, obviously, as you've just mentioned, progress against the internal targets is very positive and ahead of schedule by a number of years, so that's very good. But I think we all know that the longer it goes on, the harder it's going to get, one of those scenarios, so that's good. But has anyone got any additional points they want to make? But obviously, no. Okay, so I think that where we are is the committee has been asked to note the climate-related disclosures report attached as Appendix A to the report on progress against the Responsible Investment Plan 2025, Appendix B, quarterly voting report, Appendix C, and stewardship activities and high-level overview of funding investment managers' net zero approaches, and B, to approve the proposed changes to the climate stewardship plan companies as set out in paragraphs 34 and 35 of the report. I'm happy to move the recommendation Seconder, Mr. Grimley, thanks very much. Any, so is that agreed? That's agreed, okay. And so I'm going to move on to so thank you very much for your presentation. And date and time of the next meeting. So the date of the next meeting is the 30th of January 2026 at 10 a.m. Note, please, the change of time. We are going to start slightly later, just so we don't have to all try and weave our way through the rush hour traffic to get here for 9:30. So slightly later start time at 10 o'clock. So move on to item 13. Any other items which are urgent? There aren't any. So then I move to item 14, which is exclusion of press and public, which means the live stream will go down. I move the public be excluded during consideration of remaining items in accordance with section 100A4 of the Local Government Act 1972, exempt information. Is that agreed? Agreed. And that brings us to the end of the public part of the meeting, and the live stream will now end. I'll just wait for Angie to confirm when the live stream has ended before we move.